name's Alex Rodriguez, reminding you, you don't need a contract. You need a team of pros. Hey, what's up, guys? Alex with Bay Cities Construction here. Hey, I'm here with my friends from Tauro Capital. We're going to be talking about money today. We're going to be talking about financing your deal. If you've got a piece of commercial real estate and you're looking for some money, or if you want to develop some real estate and you're looking for some money, we're going to be talking about some of the money trends. We're going to be talking about how to finance new construction, and we're going to be talking about financing your retrofit if you need one. So don't go away. We'll be right back. Hey guys, Alex Rodriguez, we're back. We've got the construction show today. We're talking about money. We're talking about financing real estate deals. I want to introduce you to my friends Avi and Anthony from Tauro Capital. Say hi, guys, to the folks out there.
Hello, everybody.
How you doing?
Alex, thank you so much for having us.
Oh man, thanks you guys for coming.
Thanks, Alex.
I'm sure you guys battled some crazy traffic getting over here.
You know, actually, we left plenty of time. Came
Cool.
down the 110 on the express lane, and we're here.
Smooth ride.
Smooth ride, yeah.
Sweet.
Absolutely.
So, guys, we're talking about money today. These guys, they specialize in commercial real estate, and if you're interested in learning more about that, you can definitely go to Tauro Capital
Advisors.com.
Okay, cool. So for those of you that didn't watch our episode last week, just real quick, we talked about kitchen trends. We also talked about kitchen remodeling concepts and how to get the perfect look. So if you haven't checked that video out, please go check that out. We've posted it on Facebook and on YouTube. All right, so tonight's episode, we're talking financial markets. We're going to be talking about some of the current projects that they're working on, and we're going to talk about the importance and the benefits of having an advisor walking you through financing your deal. So let's talk a little bit about what Tauro is. Can you give us a little bit of info on what type of deals you guys finance in?
Sure. We're a commercial real estate firm out in Los Angeles. We've been around for this is our third year, and we work on all types of deals, anything from retail to multifamily to construction, industrial, and even a bare plot of land. We source debt and equity for investors and principals all across the country, so we're not really limited to a certain state. We can go all over the United States, serving all 50 states.
It's pretty cool. And so what type of deals are pretty common? Like what's your deal range, size-wise, of the deal? Like, do you guys have a particular...
Most of the stuff, and this is just economies of scale, but I would say that a typical, on the low end side, a typical loan's probably got $1 million up to 100 plus.
Okay.
And that's based upon sponsorship and overall type of asset that you're talking about, location, and then what the goal of the property is, whether that's a refinance or a construction or a rehab project perhaps.
Okay, cool. So let's get into a little bit. Let's talk about your role. So Anthony, let's start with you. Give me a little bit of a background on you and
sure.
And
So I've been in finance my entire life. So my entire working life started with a large captive automotive dealership financing. So we did dealership lending. We did consumer lending, and so I started with them. And then I moved to LA in 2012. Left that company in 2000.
From where? Where'd you move to?
I moved here from Texas, actually.
Oh, no kidding.
Yeah.
Normally people are going to Texas.
I know. Normally, not then they weren't, but now they are. So moved here from the San Antonio, Austin area.
Okay.
Always wanted to live in LA. Came to Santa Monica my first time in 2005, and I was like, I'm going to live here, so I did. And moved here in 2012, left my previous firm in 2014, and then specifically focused on general commercial real estate and funding that and sort of asset management and some sales and things like that.
Cool.
Yeah.
Cool. Anything else you want folks to know about you particularly?
I would say, on a personal note, I love to play golf, and if anyone hits me up, we can go hit the link sometime.
All right, that's cool.
Yeah.
All right, awesome. Avi, let's talk about you.
Avi Ushai, I joined Tauro back in 2018. prior to being with Tauro, I started out in a family office doing real estate, and then right afterwards I went out to the Middle East. I think I spoke about this on the show last time. I was a medic for the Israeli Red Cross for a little bit of time, and I love doing that job. I was helping people
That's
every
cool.
single day, and when I knew my time was to leave the Middle East, I came across Stephen Scott and Tauro, and I said, why not help people with their finances? And so I've been working with Anthony, or he's been my partner, and we've been working together trying to help America one loan at a time.
Cool. All right, so let's talk about. I guess everybody's talking about the coronavirus, so we have to give it its 15 seconds.
Yes.
So how is this extremely irrational panic affecting the capital markets right now? And where do you see this over the next 6 months? Is this something you feel like is going to dissipate, or I mean, what's the situation now versus 6 months from now?
That's a fantastic question. So fear is a driver for many people, right? So right now people are afraid of being afraid, okay?
Okay.
I mean, if we look back at history, there's this isn't the first pandemic that's ever existed, right? After World War II, the Spanish flu, I think, killed 20-30 million people, and we're still here. Okay,
We got less than 100 people infected, by the way,
right? So
in the entire country.
So is it a little bit to do about nothing? Yes, it is. However, if you look at, I think the global supply chain constraint is going to be the long-term effect. I think in the short run, for the first time ever, the 10-year Treasury fell below 1%.
So what does that mean for borrowers?
Well, right now, that means you can capitalize on some very attractive very attractive interest rates. Now, most lenders are going to install floors in that, so they're going to say, even though the 10-year may be at 1%, their floor may be at 1.5%, and so then they're going to take that small number, right, 1.5, and they're going to add their spread on it, which is their margin.
Sure.
And so, your rate may be 1.5 plus 2%, so you're at 3.5, right? So that's a fantastic rate right now. So if you can take the opportunity to refinance, and you have an asset that you've been holding off, and maybe saying, okay, well, let me see what happens to the market. Now is the time to take advantage of it, because there's a significant amount of discount in the market currently. Trend-wise, as it relates to it, and I don't have a crystal ball, otherwise I don't know what I'd be doing.
Yeah,
but
what's your thing? What's your intuition?
Yeah, I think it's going to be a U-shaped deal. I think, as we've seen with other these viruses, they typically trail off towards April, May, in which case the 10-year Treasury will probably go back up to 1.5, 1.6 and sort of level off. And then if it is a significant a pandemic, then maybe we start to see the fear come back into the market in probably September, November timeframe when the flu season sort of kicks in. So I would say that it's going to be a U-shape. I think the long-term issue is going to be global supply chain, but right now, taking advantage of where the market conditions are, it's a good time to refinance.
Okay, cool. Oh, do you have anything to add?
You got it.
Okay. So what are you thinking, do you think this is going to affect the just one last question on the coronavirus. Sure. Do you think it affects multifamily less than office space?
Yes, I think it does. I mean, it's going to where I think there are some where there might be some long-term effects is that we have seen. I mean, we're on this sort of long-term growth period that's lasted 12 years, right, since 2008, and so what's happened is that a lot of businesses have taken advantage of cheap money that's been in the market, and maybe they would have taken outside risk that they maybe wouldn't have taken had interest rates been normalized. So there are, I mean, I'm sure people have heard in the term shadow businesses, right, where because the rates are so low, they are making enough money to cover their debt service, but they're really not a profitable business if interest rates all of a sudden spiked. So in the long term, if there are significant disruptions to the global supply chain, then that may affect businesses and business income. And does that affect the consumer to go out and buy things, right? We've seen it in China where their consumption has dropped.
For sure.
And so do we see that in the United States yet? I haven't seen it, right? And I don't know that we will see it, but I think it's going to first hit Europe, and then if it does have a significant impact in the United States, then that may have an impact. But I don't think it affects multifamily in really the short term or the long term at this point.
Interesting. So, since we've had kind of a turbulent week and a half, today was no different. I saw the stock market at different parts of the day today, and by the way, today is March 3rd. If you're watching this later on, last week was I mean, it was crazy.
Right.
It was crazy. I think that every bar on Friday at the end of closing business day in New York was packed with
Sure.
a lot of martinis and
I'm
hard
sure it
liquor
was.
being served.
Well, yes and no, in that there are people that take advantage of this kind of volatility in the market, right? So I
Sure.
think there are there are traders out there that look for this type of volatility because that's how you make money in a slow growth where there's not a whole lot of volatility. There's not ways to maneuver around and make spreads. So sometimes I'm sure there were the long-term holders that lost a lot of money sitting there with large glasses of martinis, and the other ones were taking shots. So.
All right, so let's talk about some of your current construction projects.
Sure.
Kind of what's a profile of some of the jobs you guys have been working on? You can talk about something specifics, or you can talk in general.
Sure.
But just to kind of let people get a flavor for what you guys are funding.
Yeah. So we will fund anything from sort of down the fairway refinance of sort of any asset class, right? Whether it's industrial, multifamily, office, and then we'll tailor that up to the most complex as it relates to construction and development deals. And so the most recent development deals we've been working on have been some small lot subdivision projects. One of the more favorable sort of regulations that the city has allowed is this small lot subdivision. So you can buy a smaller lot that can maybe consist of a duplex or a triplex, and you can build however many units there that can support it. And they're technically townhomes in the sense that they are separated and they're individually parceled, but it gives you the flexibility of selling those to the general public, or you can keep them and rent them out as rentals. And so I think a lot of people who are in the sort of sub $15 million range as developers have taken advantage of it because it is flexible to them. And so we've done a number of those projects as a rent to ground up and refinance of the folks that are going to keep those assets and rent them out long term.
So lot size, are we talking about stuff that's between 12 and maybe 15,000 square feet?
Yep.
Is that what we're talking about?
Yeah.
Something that was a 3-unit, maybe a main house with 2 units over a garage or something in the back. You knock it down, and you can bang out probably like 25 units, 22 units.
Well, I think you're probably gonna. Somewhere between 15 to 20. I would say. Yeah. Yeah.
Okay, on something that size.
Yeah.
That's interesting.
Yeah.
So that actually is a good amount. There's a good amount of those lots in LA City.
Correct.
For sure.
Yep.
Right. So I'm thinking like the West Adams area. I'm thinking like along Pico, like just south of Miracle Mile.
Sure.
There's some multifamily zoned areas there.
Well,
like
it
La
doesn't
Brea.
actually be multifamily zoned. I think you can do it if it's zoned R1.5.
Yeah.
Oh, no kidding.
Yeah.
So not just R2.
Not just R2.
Because those three on a lot were I think R2.
Yeah.
I think it
Yeah.
was on R2.
And so you've seen a lot of it in Mar Vista. You've seen a lot of it in
Yeah.
Silver Lake. You've seen a lot of it in Echo Park, Koreatown. And it. I haven't seen too much of it in sort of the Mid-Wilshire area, although there's no reason why it couldn't. I think it's just, unlocking some of those deals, the price per unit that you might pay might be less attractive than some of the other areas in the city.
Yeah, because definitely south of Miracle Mile. So I used to live near near like Olympic and La Brea,
Mhm.
and just south of there there were quite a few like on Cochrane.
Oh,
There's
yeah.
quite a few stretches that they're 3 on a lot, 2 on a lot.
Great neighborhoods. Yeah,
Yeah.
very good.
And
neighborhoods.
they've turned around. They're a lot
Yep.
nicer. now.
Yeah,
And it's
and-
closer to work.
And the
For a
asset,
lot of people.
those asset values have increased substantially too. You know, the multifamily in that neighborhood trades pretty high in terms of the dollars.
That's cool.
Yeah.
All right, let's see. What are we talking about next year? So let's talk about your 17 unit building,
Mhm.
the artist rendering for that 17 unit building on
Sure.
in West LA. So that's 17 units.
That
Okay.
was our most recent project that we actually funded. 17 units in West LA. It was a formal duplex and a triplex.
That's amazing.
The investor actually took advantage of the measure JJJ and TOC that we spoke about on last time on your show, but just for the viewers or first time listening in, TOC, transit-oriented communities, is an incentive that LA County came out with that allows you to increase your density. So if you have a 3-4 building and you're close to a bus stop where they need affordable housing, you're allowed to increase your density. So the sponsor for this project was allowed to increase their density to up to 17 units from, I think about 10 or 11 units. One way that, when we first came across this client, they were kind of, I wouldn't say freaking out was the word because she's a very well collected person, but they only had 20% equity. And I'm sure we can talk about this a little bit more, but when you go into a construction loan, you got to make sure you're coming in with a specific amount of equity because nobody's going to give you full 100% unless you want.
No one's going to give you 100% financing for the construction.
For the
cost.
construction, correct.
You got to have some meat in the
Correct.
some
And if
skin in
you-
the game.
Correct. And the less skin that you have in the game, the higher the interest rate will be.
Okay.
So without putting her into a situation where she'd have to be paying, double digits in interest, she came to us and she hired Anthony and I, and we kind of looked over her model, her forecast, her pro forma, and we kind of gave her an idea how everything would be play out. And then we took out her construction project and we took it out to market. What we came back with was that we were able to get her a loan with up to 80% loan to cost for
Okay.
2 years interest only, and she was only able to come in with 20% equity.
Okay.
And the interest rate that we got her, which typically on something like that would go 8s or 9%, we're able to get in the 5%.
That's amazing.
So
That's amazing.
yeah, and she just started, and what other roadblocks we had with this project was she did not want to take out the loan until she had her permits and everything ready. 'Cause
So she
didn't
was
want to
RTI,
pay
yeah.
Correct.
Ready
So
to issue permits.
we worked with her. We worked with the lender until she went past all her roadblocks, got the RTIs and the proper permits, and then once everything was all set, we put everything in motion, and the lender worked very quickly to get her all our funds in time for her to start the project.
Interesting. So let me ask you this: do you see this trend, kind of like what do you see the curve of growth for this type of a project? So where you got about 8,000 square feet, something between 17 and 20 units, and so what's the build cost for something like this ballpark, for a profile building, not this one per se, but for something this size?
I would say you're probably at $250 to $275 a unit.
Okay, so we're looking at almost $3 million, something like that. Maybe
In hard cost, right?
Yeah, in construction costs.
That's in hard cost. That's not soft cost. That's not any interest carry. That's just hard cost.
So maybe $3.5 million. Okay. So we were talking about there's a lot of profile buildings there's a lot of land in LA specifically that fits that profile where you could fit a building that looks like that.
Right.
Well, by the way, do we have that? Is that on? Can the viewers see that? That's cool.
Yeah.
Yes.
So what what will be the long-term trend? I mean, I think it's just unlocking the value in the underlying asset. So when I said $250 a unit, that's just hard cost. That doesn't include your land and your soft cost, right?
Yeah, straight construction.
Yeah. So I think what will inhibit the growth what inhibits sort of this type of development is your land costs have gotten extraordinarily high.
So an acquisition of the existing land,
Right.
what would that be, like a mill one maybe?
I would say if it was a duplex, probably $500,000-$600,000 a unit for existing, right? And so,
too,
if a lot of what I've seen is the folks that have been doing this. She owned that property for a longer period of time than
So her equity was there.
Her equity was there, right?
She's also a very experienced developer, and that's another thing that we should probably talk about is don't expect after seeing the show you can just find a property and say, hey, I'm going to start building. You need to have the experience. There's a lot of factors that go into it. First off is lenders are going to look at how much experience you've had and what equity you have, and then they're going to want to know who your general contractor would be.
Right.
So let's talk about that. So the management team that you need to get you through construction, right?
Sure.
Because there's definitely been people. I mean, not everybody's a construction expert, but you can definitely lean on pros.
Your people.
Right. Yep. So if you've got somebody who's an experienced architect or engineer in this case, because these buildings, a lot more engineering goes into than architecture, I think.
Right.
This design, by the way, if you guys have seen it all over town, where you have a concrete platform and then you've got stick construction above, the companies like Simpson and MyTech have worked really strongly to develop the technology to be able to support that type of construction. It's been heavily tested. You can actually see some videos. We're going to put them on the link below of some of the buildings that were built to scale on a shake test in Japan, where Simpson sponsored the testing, and the entire building experienced an earthquake. So they put cameras and everything all over the building, and they shook the crap out of that building. It's pretty crazy to see I think it was up to 10 stories.
How did they simulate the?
It is literally an airplane hangar. It's huge, and there's a full earthquake shake table, and they build the entire building on it.
Oh my gosh.
Yeah.
Okay, amazing. Yeah.
So that's what I was saying. I was talking earlier with you about how the engineers have gotten very comfortable, and actually there's a lot of our friend Joe who works at BMC. He's a retailer of the Simpson products and the MyTech products, and he has become so accustomed to reading the plans so that he can help the construction team price out how many connectors, because literally there's thousands of connectors from the roof all the way down to the ground that are necessary. So he's got a lot of experience doing that. So having a team in place that can do that is a super, to your point, it's a critical part to get the financing, right? Not having your equity position, you're having enough money to cover your position isn't enough. You need to make sure you can convince the lenders that this will happen and it will be successful.
Absolutely, right. So your team is vitally important. So having someone that can, like us or anybody that's in the capital market space, that can advise you on how you're going to get the project funded, and then making sure that you have the right engineer, you have the right general contractor, you have the right architect, and that you have someone that can get your plans through the city is vitally important, because getting to RTI is not easy. It can take up to sometimes 2 years to get
two and a half years. I've heard that. Yeah.
Yep. So, and the city of LA is not that quick, right? So you've got to plan. You've got to have that contingency plan in place, and you have to assume that something's going to go wrong, because as you guys know, because it will go wrong. Yeah, absolutely.
So let's check out this one. The artist renderings for this Atwater job.
Yeah.
18 unit. So what's the breakdown? Is this a townhouse? Is it a condo?
Well, technically, like I was saying, they're actually called small lot subdivisions, and so there is a small gap in between each one of those houses, right? So they look connected, although they are not. They're individual wood frame construction
next to each other.
Yep.
Wow.
So they cover up the gap, but there is one, and so they're all separate parceled, which means they all have their own APN number. And
so it's for lack of for many people, I think, are used to calling this an attached townhouse.
Yeah, okay.
Right.
That's right, exactly what it is. Okay, and so the city of LA has been favorable to this kind of construction because it's allowed for them to build, it's allowed for developers to take smaller lots and build this type of product that is, selling, given the neighborhood, somewhere between $800,000 and $1 million, which is a good price point for LA. Yeah. And there's no HOA.
That's right, because everybody owns their building.
Correct. Right.
That's interesting.
Right.
So you have all of the positive aspects of using as much square footage as you can without the negatives of dealing with the hellacious HOA.
Correct.
Yeah,
Yeah.
that's cool.
Yeah, so it's you'll see them pop up. Mar Vista's been a very good neighborhood for it. Echo Park, Atwater Village, Silver Lake, Los Feliz. You'll see them pop over.
So what's the designation that they call it? What did they call
it's
it?
called a small lot subdivision.
Small lot subdivision. That's good to know.
Yeah.
Okay.
Yeah.
I'm wondering if they'll eventually adopt that here in the South Bay
Yeah, I think they should, right?
to get rid of the HOA. Right?
Yeah,
To get
yeah.
rid of the HOA.
It really is a net benefit to the owner of the ending owner of the asset.
I think the major reason, I mean, other than wanting a backyard, the major reason for people moving out of a condo is that they somehow, their HOA turned into a negative experience.
Correct.
Right, and it's time to
Right.
sell and get the heck out.
Yep.
So tell us about this one here.
That's that one.
That's the backside of Atwater?
Yeah, that's
Okay.
the same one. Yeah.
That's cool.
Yeah.
So everything,
Yeah.
so for those of you, so just clarification for those of you watching, you come in on your garage, you own all of the vertical real estate.
Correct.
Right?
Right.
There's no other owner that's above you.
That's right.
You're basically, the stucco joins your building, but that's for aesthetics. You own your structure.
You own your
You're
structure.
freestanding with your gas, your water, your electrical,
Correct.
your HVAC is all yours.
Is all yours, right? And so, what they've done is a lot of them adopted some very cool aesthetics too. So you pull in your garage, you might have a first floor, one bedroom, one bath, and you go up, and these ones specifically are doing they're doing the kitchen on the third floor, and then you can go up the stairs and have your own great roof deck with great views.
That's awesome.
So you can cook on the third floor and then go enjoy it. Best of Southern California on the roof deck.
Yeah, that's cool.
Yeah.
All right, so let's talk about protecting your investment. So
Sure.
for this is kind of like this is I think one of the projects we're looking at in the valley. This is the like the great grandfather of the buildings that you just showed, right? So this is these are all individually owned, and I think in this picture they're individually owned, and some of the other ones it's an apartment building and they're all meshed together. But when you have shared ownership and you have an HOA, you got to split the cost, even though there may not be any retrofit happening on your actual building. So buildings like this, pretty much in LA, all of the building, about 80% of them are at least RTI'd. The holdouts are the largest pieces of real estate, which are HOAs, because they haven't been able to get their act together and agree.
They were also the last in the city of LA, correct me if I'm wrong, but they were also the last to get served, correct? Again,
They're high priority.
Oh, really?
Yeah.
Oh, interesting.
Yeah,
Okay.
so this double-decker construction basically makes them at higher risk because the building weighs more.
Oh, okay. So they didn't. So I thought. Okay. So I was under the impression that if it was an HOA-owned building, then even though it was soft story, it had a soft story component. They were serving those HOAs last and doing the multifamily first.
So in the level of priority for like the risk assessment of the building,
Yeah.
these are the worst.
Oh, right.
So I think it was anything over 15 units and having 2 stories above the two living quarters above the parking garages, they're the highest priority building.
And so isn't there some calculation too based upon open space as an inclusive of windows, right? So isn't that a very sort of unstable building based upon the opening and then also the amount of gaps there are in the windows? Is that an analysis that you guys do?
The engineers take that into account.
Right.
So what they're measuring is the ability of the building to resist lateral force, right? Mm-hmm. So the earthquake makes the building go back and forth and left and right, and kind of in layman's terms. So what you want to do is you're measuring the more windows you have, the more openings you have on that plane. If you think about it like as a geometric plane,
right.
And the more holes you punch, the more that plane will flex.
Yep.
Okay. So the stronger the earthquake and the closer the earthquake is to the building, and the soil composition of where the building sits, determines how much you have to do engineering wise to meet the existing standard. Now the buildings the standard is not to bring them up to the current code. That's not it. In fact, most people don't know this, but the minimum standard is that the building doesn't kill you. That's the goal. The building could get red tagged. It could be eventually maybe demolished. But the idea is that we retrofit the building to the point that it doesn't collapse and kill people.
Right, like it did in 92, right?
In Northridge, yeah.
Northridge, right. So you saw a bunch of these buildings pancake, correct?
Yeah, that's right. So the longer they are, like this building that's in this picture, the scarier they are, because it's heavy and the shape of of the building and the fact that it's offset. Like there's part of the building that's on grade. Behind that wall, the building's on grade, and on this side of the wall, it's at a different height. All of that stuff, no one really knows exactly the frequency of the building, which is how it's going to move during the earthquake. But they know, based on a lot of the engineers went and did forensic stuff on the buildings that collapsed back then, and they luckily recorded a lot of the data and a lot of their findings. So the engineers that have been working here locally in Southern California, many of the seismic experts are very familiar with how these buildings will fail. The question is that there hasn't been the political will to write a law like they did, and San Francisco was the first one because of the cost and everybody's has freaking outrage because it's going to be expensive. The average cost for a lot of these smaller buildings, it's going to be $100,000. Somewhere between 75 and $100,000 on the low end. Large buildings like this could be $500,000 plus.
And so they're saying that building is more of a risk than like an old bricker, like that you would see in
a brick building will just kill you.
Okay.
A brick building, when it collapses, like what you saw in Mexico City,
right,
there is no room for escape. It literally is like a sand castle, and it collapses. There's no gaps in there. Here, what will happen is the building, in some case, well, not in this case, but I mean, it's hard to say how this building will break. But
sure,
typically, the beam, this gravity beam here is probably steel. In other buildings, it's wood, but it'll twist, and typically the overhang rolls over and it makes it break at the post.
Oh, okay.
So you have a partial collapse or crushing. For buildings that are missing a corner, those could fall.
Okay.
Those are very probable to fall.
So,
But they'll break here and they'll break on the corner. So because that connection is very weak, it's meant to hold gravity, not lateral force.
So the retrofits that have been done, because there's a lot of these buildings still in, call it Koreatown, and so those old brick buildings that have been quote unquote retrofitted.
That's next.
Oh, that's next. Okay,
Yeah.
They haven't done that yet. Okay.
Yeah. So some of them were retrofitted, I think, in the 90s. And what you see, those steel plates and all that, that's meant to keep the pieces bigger.
Oh, interesting.
So you're gonna have big pieces falling,
right,
instead of like what you saw in Mexico City, where it turns to like sand. I mean, it just, there's nothing left. It's just one big rubble pile, and if you're in it, like you're not gonna make it.
So just because again, I think this goes back to financing, right? So if a client that I have calls me and says I've got an old brick building built in the 20s that's in Koreatown, for instance, right? And they're looking at it and saying, okay, well, I'm going to need to retrofit this, I think. What can they expect in terms of like how are they?
It's in the hundreds of thousands.
Is it really? Okay.
So these wood buildings are way cheaper to retrofit. It's probably a 10x component.
Wow.
It's a big deal, and the engineering for them is a big deal. These buildings have been engineered for probably $6,500 for the retrofit.
Sure.
They probably should be about $12,000, but it's gotten down. All sorts of folks that have never done a retrofit started doing these, so it's like the Wild West. It's kind of a crazy situation.
Right.
But the engineering's down about $6,500. The engineering for those brick buildings is not going to be $6,500 because the liability it's a different thing. The likelihood, if you didn't retrofit the building, it's going to get red tagged, and very likely the building will not collapse. Mm-hmm. You'll be able to make it out. The brick buildings, it's very likely that you're not going to make it out. So the liability is very high. Yeah. Because people are going to be like, I'm going to spend $1 million or $1.5 million or $2 million to retrofit this building, and I spent, by the way, $300,000 to do the the engineering for it, and you're going to tell me that the building's going to fall. Like, the building was badly built. Many people, I think, should consider, and I think that anybody that understands construction and engineering has come to the realization that after a certain point, you should just knock down the building.
Yeah, that was my next question, right? At some point, the cost to rebuild, right, is probably going to be better, and you can achieve more from, sort of a end value perspective by tearing it down and building.
And you'll get more density. You're going to get more density for sure.
Yeah.
So if you've got one of these buildings in downtown, the peripheral, we were at the tower having dinner at the old Arco Tower. What's that called, Brian?
The one that spins?
No, the old Arco Plaza areas. Those two twin buildings. I think they're kind of a black stone building. They're big old. It's on Fig and 7th or something.
Paul Hastings.
Oh yeah, our office is literally kitty corner from there. Paul Hastings building.
Right.
Yeah.
Well, those buildings have some issues that people have brought over the years. But we were up at the City Club deal, and you could see a lot of South downtown from there, and you could see probably kind of like 25, 30 buildings within the immediate maybe 10 block radius of where we were.
Westlake neighborhoods and like K-Town and
so if you've got a 20 unit building, 30 unit building, if you got a 40 unit building, you should probably just knock that down and build something amazing.
Yeah, I mean, you can get a great construction loan right now.
For sure.
Yeah, and the only caveat, right, and I think this goes beyond sort of our conversation, but it goes to a broader conversation as it relates to regulation and rent control, is that, the city is saying, look, you have this old brick building, it probably will kill all your tenants if there's a major earthquake, but
you can't kick them out.
And in order for you to sort of rehab or replace that building, you're going to have to pay all these tenants to relocate. And so does that make the cost less efficient, and do I even want to do it, right? Maybe it's just better to sell it to someone else and let them take on the headache. But yeah, it's a significant disconnect, right? Because you're saying, look, this building could kill you, but we're not going to let you relocate your tenants without paying them a significant amount of money to do it.
There's no question. I think that there's a very big there are these forces pulling apart, right, at the seam. You've got like that person the tenant that's there paying $500 a month will never find anything. It doesn't matter how much money you give them; they will never find a $500 a month unit.
Not for what and not for this. They probably have a 1-bedroom that they've been in for a long time, and it's beautiful inside, right? Yeah.
So even if you give them $25K for a family to relocate, which is I think the maximum amount,
it's a minimum. Well, I think it's there's a whole scale to it. It's
But let's say you give them 25, 30 grand.
Right.
Okay, good. That'll be gone in about 6, even a year. Let's say you find something for $1,200.
Yeah.
A little hole somewhere for $1,500. That'll be gone, right?
Yep.
You're not going to get a $600 unit somewhere else. So the tenants don't want to go, and some of them that are smart, they don't want to go at any price.
That's right.
Because that still solves the house. Like they don't want to leave LA, but the building will kill them.
Right.
Like it's very, very likely that if we have a very significant event. See, Northridge, most people don't realize, Northridge was only about 11 seconds. And it was 15 miles below the surface of the earth. If we would have had an earthquake like we had at Ridgecrest last 4th of July, it would have been catastrophic in LA. When Brian and I went...
Is that the one up in Bakersfield?
That was the one up in, it was felt in Bakersfield, but it was north of Lancaster.
Okay, that one, okay. Right.
So it was those faults, and it was shaking for months after that, right? When we went out there, we did some drone footage, and we kind of stood up on this little area where you could see far away. You could see the earth scarring, what's called lateral spread, for 8 miles. It went into the horizon.
Wow.
So if you had a subdivision there, it would be all gone. Any building, there was one section where the brick building stayed, and the 2/3 of it slid. During the earthquake, the soil liquefied and it just slid, and the building was broken in half.
Oh my God!
So you can't engineer about that, people.
No.
There's nothing you can do. There's not enough stuff I can put in a building that'll keep it together when that happens, right?
Oh my gosh!
And guess what? We live surrounded by faults that could do that. Okay.
Yeah.
So that's a reality. So we've got the tenants that want to leave. We got the reality of the building was built out of brick, which is the worst thing. And then, by the way, there's an earthquake fault right around the corner.
Yeah.
So that's something that LA's going to have to reconcile. It's been a conversation that I read Dr. Lucy Jones's book, and this is a point of contention that has been talked about from people that lived in Pompeii.
Yeah.
During ancient times, people were like, "Hey, listen, there." And in that case, it was very clear, right? Like, that's a volcano.
Right.
Like, we live right here near the volcano, and so people are like, "Hey, maybe we shouldn't build the city next to the volcano." Like, no, we want to live by the volcano, and this kind of back and forth. We know how that ended.
Yeah.
It wasn't good.
Yeah.
It was a bad idea. So look, before we go, I just want to
Sure.
I want to kind of give the folks a little bit of insight moving forward.
Sure.
Where do you see financing? What do you think the trend is for the rest of this year, financing wise? Do you think rates are going to go down? Do you think they're going to stay stable? What do you see in that respect?
Great question. So I think that there is plenty of capital still out there, dry powder as you might call it, right?
Okay.
Ready to deploy, right?
Okay.
And so I don't think there's going to be a lack of capital in the market to deploy. I think that if we continue on this path of a fear-based approach based upon the coronavirus, which again I don't even like talking about, but would a lender start to take a second look and say, hey, maybe we're going to hold off because that's maybe a little bit too risky? Sure, I think that's probably a fair assessment. I think that in the short run, anybody that's been thinking about refinancing, go do it now. I don't care who you work with, what you do, doesn't matter. Go get it done, because you can take advantage of a very short-term blip in the market that you should absolutely capitalize on.
Okay.
I think by the end of the year, we'll probably end up, I would say by midway through the year, June, July, we'll probably be back to where we were before this whole coronavirus thing started, which is 10-year at around 1.5, 1.6%.
Okay.
And I think that there's for folks that don't know, sort of outside of calling Chase, for instance, right? Chase is a great multifamily lender, but outside of calling Chase, maybe people don't know. There are opportunities to use life insurance companies. They have a mandate of deploying their unused capital on commercial real estate every year, and so they're sort of agnostic based upon what the cost of capital currently is, because they have all of their premiums coming in, so they have a lot of cash that they have to deploy. So for a great multifamily asset in the city of LA that's, call it, above $5 million, you can probably get a rate below 3%.
That's amazing.
For 10-year money.
So one of the things that I'm kind of getting from this conversation is you guys can really shop a bunch of different money markets.
Absolutely.
Right? Like, that's the big advantage.
Short term, long term,
and that's really our value proposition, and sort of why it's important to use an advisor in the market, because our sole job, just like yours, is to advise people that own real estate on how to fix their issues and
Sure.
and get the best sort of use out of their building. Our value is that our sole job is to monitor and understand what's going on in the capital markets, and so we know the trends that are happening. We're talking to these lenders every single day. We're bringing them into our office every single Tuesday. This is our sole focus and our sole job, and so we can drive and find the best value in the capital markets, and that's why people hire us.
So in some cases, we're talking probably like a savings rate-wise of maybe 30%, or maybe getting a deal funded that, because I think from what I'm learning from our conversation today is that finding the right fit of the borrower's project with the right funding agency or funder,
Mm-hmm.
right, is. You many times you go outside of maybe even go outside of a bank. So we had talked about maybe going to private capital for some projects, right? So
Right.
So let's talk a little bit about that. If a traditional lender is at, let's say, 5.5%, what would a private capital look like?
I would say you're probably going to pay, depending on the asset and where it's located, right? Location is always key, but I would say somewhere between 4 and 5% above what you would pay at a bank, right?
And what do you get? So what's the benefit, like, so for the higher premium?
Yeah, so most of them, there's far less regulation because they are unregulated lender, right? They don't have the state or the federal government to comply to, so they can give you more per more money per sort of. So they can provide a higher dollar amount for your project, like a higher loan to cost perspective. Higher loan to cost. They are much easier to work with because they're not regulated, so they look at themselves as partners to you, and a lot of times they're non-recourse, which means you're not pledging any other assets other than that current asset itself. I mean, there are some extenuating things to that, but in layman's terms, if it's a non-recourse, in theory, as long as you are not not doing anything fraudulent and you're complying with general good business terms, then the only recourse that you have is the actual property itself. So that's one reason why they have gone that way, is because you can get non-recourse money for the same project that you would pay for a little less premium, but for recourse, right? So
interesting.
Yeah.
No, and that could be huge depending on what the profile is of the borrower. Right?
Absolutely. Depending on what your portfolio looks like, having non-recourse in commercial real estate is always the goal, right? Everybody wants non-recourse because it's subject to that asset alone, and you're not pledging your other assets.
I think you have a good idea of what you're risking, right? What's on the table.
Absolutely.
Hey, so Brian, let's talk about some questions. We got any questions from the fans out there?
One of our viewers wants to say hello. I believe it's Renata.
Oh, cool. Emily, right on. Thanks for watching.
Somebody did ask that the Feds just recently dropped rates, so is this a good time to borrow money?
Yes.
Absolutely.
Yes.
So what happened actually is the Feds were, you could call it late to the party or you could call it premature to the party, but we saw a huge decrease in the 10-year Treasury based upon the Fed just lowering rates. So as we said before, your long-term borrowing at call it a 10-year term loan, you can you're borrowing that at call it sub 4%, maybe 3.5% right now, and that's fantastic.
That's amazing.
Just to give you an idea, last time when Steve and I were on the show,
Sure.
the 10-year Treasury was 2.7, so you were getting multifamily loans for 4.25%, and just the other month I closed the loan for a client of mine out in Eagle Rock. The rate was fantastic, and they went to Chase originally, and it was really easy to work with Chase, but their rate was a little bit higher, and I said, hey, we can find you something that will fit you, because in the end of the day, a loan is just like, I look at it like a marriage. The sponsor and the bank are going to get married for X amount of years, so got to make sure it's the perfect fit for a relationship. We ended up beating Chase's rate by nearly 60 basis points.
That's amazing.
Yeah, and not
That's
only
real money.
that, the rates have even dropped, so we ended up securing a 10-year rate for 3.79, and I'm working on a couple loans right now. You can get a 10-year rate, anything below $5 million, for 3.2 to 3.3% fixed for 10 years. So it is a great time to go after and refinance or to finance your loans.
Cool.
That's a significant savings.
Yes.
I know it doesn't, when most people think about or talk about rates and financing, they look at it sort of myopically, but if you actually look at what that savings is over a 10-year period, it's real money. It is a significant discount.
We saved her $33,000.
There you go.
Yeah, that's big money.
Yeah.
What else?
There's another viewer that wants to know if Tauro can help them with construction loans, construction bridge loans.
Absolutely.
Feel free to reach out, and we'll be happy to sit on a phone call with you and kind of go over what your construction project is and see how we can help you out.
Cool.
Somebody else wants to know, should I pull the trigger on a refi?
We can ask a question, but assuming that that you're, there are things that go into deciding whether you're going to refinance, which is your current prepay, perhaps, the costs to take out your existing lender and put a new one in there. So, assuming that the cost savings of the rate today versus what you're going to possibly pay and prepay, if that is a net positive, then yeah, I would say it is a good time.
Somebody else wants to know, is this a good time to invest in real estate?
That's a bit of a loaded question.
Yes.
I mean, I would say that real estate is always is typically a good asset to invest in. I think commercial real estate specifically is a great asset, but it is an asset that you don't want to go into blindly, right? So you want to make sure that if you're not an expert in construction, if you're not an expert in asset management, if you're not an expert in maintaining a building, that you have the right people in place that know what they're doing, that are trustworthy, that can do that work for you, because it is a significant portion of most people's net worth, and going into it blindly can cause problems.
So let me ask you this to your point. I think one of the biggest mistakes people do is they start too small. And this is what I mean by this. If you don't buy a piece of real estate that's big enough, you don't have the cash flow to hire people with the experience. If you have the experience and you do construction and you understand real estate costs and values and management, okay, cool. I'm not talking to you. But I'm talking about somebody who maybe inherited. I come across a lot of the properties that we relocate, people that we refurbish. People have inherited, and we do remodeling and additions and stuff like that. So I came across a family who the son inherited 3 buildings. Okay, well, it was a house and then a couple of apartment buildings.
Yep. So
somebody that's in that position can either rent those, refurbish and rent them, or sell it and buy a big piece of real estate. So maybe if in this case, I think all 3 were paid off. Let's say he had maybe $4.5-5 million worth of, that you could 1031 exchange and transfer that equity. You could buy a pretty big sized piece of real estate, right? What do you think about that? Like, what do you think about like the size of real estate when you're taking that into account?
Yeah, so I think that obviously if you're going into it without the expert knowledge, then hire someone that does, right? So you can evaluate, certain things that go into owning real estate, like rents and what rents will look like in a couple years. No one has a crystal ball, but you can make your best guess. And I would say that for the folks that have inherited significant portions of real estate, what that typically is what we look at as a wealth transfer, and what most people have, what I've seen in the areas of that where you've inherited maybe 2 or 3 multifamily buildings, is that most of the kids tend to sell them. And because you get a step up in basis to actual real market value, so you're not paying long-term capital gains.
Yeah.
And so you don't have to 1031. You can literally, if you inherited a building, in most cases you can get a step up in basis and sell the asset at fair market value and not pay any capital gains. So that's real cash coming to you that you can go do whatever you want with. But if you are a novice, I would say, and you want to stay in the real estate business, keep the assets that you have and don't sell those. And because you're maybe growing in scale, growing in scale also is growing in problems, right? And so not always buying a bigger piece of real estate and using leverage to purchase those things, to purchase those assets, if you're a novice, may not be the best result. I would say that if you have inherited that type of asset, I would personally keep it and just rent them out, because they've been sort of managing themselves, I would imagine.
Okay.
Yeah.
Well, how do you see the series of what most landlords would consider negative legislation coming out of Sacramento for landlords? I think the intention of most of those kind of the extension of rent control type of legislation, or harder to evict people.
Sure.
What type of risks does that place moving forward on
Well,
landlords?
yeah, so I think, rent control is always, the Rent Control Act that was passed in 95, and I'm blanking on what the name of it is, but it was passed in 95, basically said that if your building was built prior to 1978, it's subject to rent control, and the rent control board in any given city will dictate. It sort of put onus back on the local communities to drive rent control.
Right.
Most people probably hated it when it was passed, but now they don't want it to go away now because, increasing rent control, if you look at the long-term studies of it, is bad for business, right? It is bad for business. It's bad for It's bad for competition. It's bad for housing starts. It's generally not good for any city. And so folks that are in sort of Sacramento that are looking to increase rent control, they're hearing it from the tenants, and they're looking at it from an affordability component, and they're saying that we're going to try to solve the affordability problem in the state of California with increased rent control. But if you actually look at it, increasing rent control ordinances will increase the gap because people will just simply take their buildings offline and rent it to their nephew, and they won't report that unit, and then that's one less unit that's going onto the open market. So I'm a big component in open market conditions because the market will be the driver of competition, will be the driver of price, and so artificially regulating prices through rent control, I don't think is a long-term strategy. It can't be a long-term strategy for cities. It's my opinion. But.
Well, I think that many would argue that if you allow the very basics of supply and demand, if you have, the reason that we have all of these upstarts now is really 100% cheap money. If we did not have cheap money, the level of building in LA County would not be anywhere near. Would you agree on that?
I would agree that cheap money has allowed for increased unit production. I would agree with that, but one of the things that's hindered additional growth and additional units coming online is the amount of regulation that's attached to it.
For sure.
Yeah. So they've taken advantage of cheap money, but the regulatory conditions to do that have made it unsustainable in terms of being able to build a building that's going to be profitable. And
what we're talking about here, what he's addressing is, in some places the impact fee per unit is like, it could be $20,000, right? So if you're building a 17 building, that's a lot of money. If you're building a 30 or 40 or 50 unit building, I mean, even if it was, let's say half of it was $12,000, it's still ridiculously a very significant amount of money before you even put one nail on a 2x4, right?
Absolutely.
So these are things that I think that need to be considered. We're not always going to be in a cheap money environment, and I think that more rent control is just one more piece of regulation that people have to navigate, and definitely.
I just think they did pass. I think they've limited it now to like an 8% rent growth, which, look, I don't think anybody's. I don't think that's going to be as bad as sort of making. If you look at other cities where there's really impactful rent control, like Washington D.C. has very, very rigorous rent control.
Mm-hmm.
Parts of New York have very rigorous rent control. I think what they ended up passing in California, I think, wasn't as bad as it could be. I mean, for your viewers, if you ever want to look at it, you should look up the rent control laws in Washington State or in Washington D.C., which will actually allow for tenants have the right of first refusal to buy your building if you sell it. There's a whole thing to it, but you should
crazy.
Look it up. It's pretty crazy.
Cool. Well, hey, if you guys want to learn some more about construction, obviously go to baycitiesconstruction.com. If you want to learn more about Tauro, you can visit their website, and their info's here. They're in downtown LA off of Flower. And I want to thank all the viewers for watching the show. Hope you enjoyed it. Please comment below. If you haven't subscribed, go ahead and hit the subscribe button. Hit the little alert bell if you're on YouTube. On Facebook, you can always like us. Do you guys do we have your Facebook? You guys have Facebook?
Oh, yeah,
We
of
have
course.
LinkedIn, Facebook,
Yeah.
Instagram.
All right, cool. So I'm gonna post on this card your email addresses so that folks, if they want to learn more about what you do, get some information on borrowing, getting a loan for their deal, they can reach you.
Yeah, you can
Our
put
contact.
you can put my LinkedIn in the show notes too.
Our
Okay,
contact info is on our website as well.
Cool. So hey guys, thanks for watching. My name's Alex with Bay Cities Construction. Reminding you, you don't need a contractor. You need a team of pros. And if you need more information on soft store retrofitting, please go to softstoreretrofitting.com. Softstoreretrofittingpros.com. Thanks for watching. I'll see you.
Thanks, guys.
Do you know that a big earthquake can produce a wave that's 2 feet tall? Hi folks, I'm Alex Rodriguez, and I want to protect your house for $199 a month. I'm the owner of Bay Cities Construction, and after visiting Ridgecrest, it's clear to me that you can prevent a tremendous amount of expensive damage by having a seismic retrofit done to your raised foundation. Have you ever wondered if your house needs to be bolted down? And have you ever wondered what could happen to your house if it's not braced and bolted down? Let's check this out. Let's get down and dirty. So this is how we do a bolt down. We bolt down the mud sill to the stem, then we connect the floor joist to the mud sill, and then ideally you connect the subfloor to the floor joist. That's the system to keep this connection intact while the floor is violently shaking. Our low-cost financing makes this project affordable. The process is easy. It only takes 1 day. We live in earthquake country. Dr. Lucy Jones reminds us that earthquakes are random. We can't predict earthquakes, but we can prepare. Remember, it only takes $199 a month to protect your most valued investment. Get peace of mind with a Bay Cities Construction seismic retrofit. Protect your largest investment. Go to baycitiesconstruction.com and sign up today. My question to you is, can you over-engineer a house for an earthquake? Look at that. You tell me. The big question is, did we do enough? I'm Alex Rodriguez reminding you, you don't need a contractor. You need a team of pros.
I love Los Angeles. Movie stars, surfing, one of the most diverse cities in America. Some days, it feels like paradise. But any second now, that could all change. Because the big one is coming.
We're better prepared for the big one than any big city in America, which is to say, we're woefully unprepared.
An earthquake so large that the Los Angeles you know will be gone.
It's going to be chaos.
Thousands of fires will break out all over the city. The power will go out. Clean water will be scarce.
They don't understand that it's not going to be just one big shake, but it's going to be thousands of shakes for months or years.
There's nothing we can do to stop it, but we can get ready.
My name's Alex Rodriguez reminding you, you don't need a contractor. You need a team of pros.